Thank you everyone for coming to our Explaining the Capital Stack and Available Funding Alternatives webinar today. This is brought to you through 3 Steps to Startup, which is an initiative that was funded through RC and with a gracious match through Benedum Foundation. So let me just give you a little bit of background of 3 Steps to Startup. There are 3 steps that we consider important to startups. First is education. And that's what we're doing today. We're doing a webinar, and that's step 1 is educating potential entrepreneurs on available opportunities and what can occur. Be sure to check out our website for other master classes and podcasts and blogs that go on to other subject matters on education. Step 2 is commercialization, and we have grants available to help businesses who are ready to start from that, maybe a back of a cocktail napkin forward. And then step 3 is investment. And West Virginia Jobs Investment Trust, the state's venture fund, who I work for, is in charge of step 3. And that brings us to the conversation we have today. And as you see here is the capital continuum. We use capital continuum, capital stack to discuss a business stage and the kind of capital that a business is going to need. So we talk about capital stack. What exactly are we talking about? Well, it's the layers of capital needed to either fund a business or a business project. And as you start to look through this chart up here, you're going to see a lot of overlap. Entities that provide capital outside of traditional banks can come in different areas of business stage and funding stage, and fund different areas of projects that a business is looking for. In addition, there are certain kinds of capital that are best suited for different kinds of projects. And that's what today we're going to be talking about. Today we have 5 of those layers represented, and each layer and each person is going to talk about their organization, where they fit into the capital stack, what an ideal project looks like for them, and they'll also give us some real life examples. After they've given their presentations, we're going to open up to Q&A. But as we've been saying all along, if you have questions as we're going, feel free to put those into the Q&A box. So as we go through the webinar, feel free to add to the conversation in the chat box as well. I'm going to go ahead and introduce our 5 panelists and then let them begin the presentation. So first up, we're going to have Tim James. He's with First Microloan of West Virginia. Tim James serves as a loan officer with the First Microloan of West Virginia, the first organization in the country to offer the Small Business Administration microloan program across state lines. The program provides financing at a fixed interest rate for us for use in opening or buying inventory, purchasing equipment, or supplementing working capital. Next up, then we will have Steve Webb with the West Virginia Economic Development Authority. Steve Webb is the Director of Financial Services for the West Virginia Economic Development Authority. The organization is charged with the developing and advancing the business prosperity and economic welfare of the state of West Virginia by providing financial assistance in the form of loans, direct financing, and operating leases to industrial development agencies and enterprises for the promotion and retention of new industrial development. After Steve, Kevin O'Connor with Partner Community Capital will do his presentation. Kevin O'Connor serves as a senior business lender for West Virginia with Partner Community Capital. The organization works to provide entrepreneurs who can't get a yes from traditional lenders the capital and strategic advice they need to grow. He brings over 20 years of bank management and lending experience and is passionate about working with small business owners. After Kevin, Brad Sargent with the West Virginia Jobs Investment Trust will then do his presentation. And Brad is an investment manager at the West Virginia Jobs Investment Trust. The state of West Virginia's Venture Capital Fund. JIT is a public venture capital fund created to develop, promote, and expand West Virginia's economy by making investment funds available to eligible businesses, thus stimulating economic growth and creating or retaining jobs within the state. Brad evaluates investment opportunities, performs due diligence, and serves as a mentor for JIT portfolio companies. And last but not least will be Mike Green with Mountain State Capital. Mike Green leads Mountain State Capital's Morgantown, West Virginia office and is an experienced early stage investor, successful technology executive, and community leader in the greater Appalachian region. Since 2002, Mike has focused on investing in and advising a portfolio of early stage companies, including companies that were ultimately acquired by IBM and Target. Mike's prior operational experience includes serving as the president of field operations for Mark and Loud Cloud Incorporated and a decade managing worldwide sales and marketing for Pittsburgh-based Four Systems Incorporated until its acquisition at $2.5 billion. So I am now going to turn it over to Tim, and I appreciate all of these presenters presenting today.
Great. Thank you, Michelle. Good morning, everybody. As she mentioned, my name is Tim James. I'm with First Microloan of West Virginia. She pretty much spelled everything we do, but I'll go through it again. We are actually what is called an intermediary lender for the Small Business Administration. We provide what is called the microloan program. This is a loan program that can do up to $50,000 for a small business. It's predominantly used for purchase of small assets, working capital, inventory, equipment, things of that nature. We cannot use our funds for purchase of real estate or renovations to real estate, leasehold improvements, etc. Can now start to use some of our funds to refi existing business debt as long as it's basically justifiable business debt. We're predominantly here as a partner with everybody on the panel, as well as the commercial lenders throughout our regions. We actually cover 3 states now out of our main office. We have southwestern Pennsylvania, 6 counties there. We are covering 38 counties in West Virginia. We also have 5 counties over in Ohio as well. So we're covering a nice little territory. We predominantly are working with the clients who are not truly the traditional bank ready, that they, some of the lenders will, they have certain requirements and the customer might not be right there yet. They come to us to get them bankable, for lack of a better word. And we do partner with other organizations to do multiple projects, larger projects, etc. So our job is quite simple. We are all about economic development. We are here to get the business started, get them to a point that they honestly do not need us anymore, that they can either pay us off directly, have us refied out. We get them to a point where they can go directly to the bank, and it's cliche-ish, but that they do not need us anymore. That's our ultimate goal, is to not be used. You don't hear that a lot from a lot of other banks and so forth. But we are actually one of the unique agencies that kind of don't want you to come to us if you don't have to. But we are available and we work with everybody. We also provide technical assistance. You'll hear a few of the other folks talk about this as well, but we actually work with our clients to keep them in business. We're not here just to give everybody money. We're here to help you foster growth and keep you growing and expanding and just moving forward, especially in this day and age. That's the hardest part of what's going on. We are also, we love to do restaurants, which is a very hard thing for a lot of banks to do, because restaurants are one of the highest risk industries. We will do just about anything that somebody can buy us lunch every once in a while for. It's a joke on our end, but we will do a lot of the things, as I said, that your traditional lenders or other agencies are unable to do. We do have, the basis. We have the same stuff. We have to have the credit report. We have to have the business tax returns, the business plan and financial projections, just like your traditional bank. And we have a review process that we work with everybody on. We have our own loan committee that helps to make the decisions. The loan officers, we have myself and another gentleman, Taylor Farrell, that he's out of the Charleston office, that cover West Virginia. And then April Casilla, who covers our PA region. And if there's any other questions, I will be on this whole time. We're here to help. And I do, as I mentioned, I partner with everybody on this panel to do whatever is needed. And that's the whole spiel. And I saw a question here, couple questions.
Tim, this is, yep.
Yeah, go ahead, Michelle.
Go ahead. I was going to say, Tim, there's a couple questions there if you
Yeah.
want to go ahead and answer those.
I had one that says, can your funds be utilized for app development fees? Will there be collateral needs? That's a very good question. We have explored into that. Sometimes the SBA is a little bit different on like that type of a project, but we can get into that. And as far as the collateral needs, yes, we do have the traditional collateral needs. We have done some unsecured piece, but traditionally we strive to get like a dollar for dollar collateral backing. And what I mean by that is for every dollar that we lend out, if we were able to get it up to $1 worth of collateral, that will actually be what we strive for. Now, there are some instances that we have been had some shortfalls on, but we look at both business assets and personal assets as well, because there is a personal guarantee that has to go on these loans. So it actually, we can get to where we need to be. If there is some shortfalls, the strength of the business, the idea itself, will actually be stronger pieces, because we are very strong character-based lenders. So sometimes you can have a little bit of a shortfall on the collateral, you can have a shortfall on the credit, but you have to have that character piece. So that's one thing that can help along things like that nature that might have some collateral shortfalls. And I hope I answered that question good enough on that. I can come back to that as we need, but there was another question I want to get to as well. One was, are nonprofits included? With the SBA microloan program, it does have to be designated as a for-profit entity. We can do some certain types, one of them being like child care centers. That's pretty much about the only nonprofit / not-for-profit entity that we're able to do. And that's a designation from the federal government. Congress is the one that kind of comes up with the rules on the SBA and the microloan programs. They are looking to adapt some of those rules, and the nonprofit question is one of those that are looking to be addressed. So this might actually change in the future, but as of right now, we predominantly deal with for-profit entities.
And then very quickly, Tim, one of the other questions is, how often does your committee review applications?
Our committee, it's a volunteer committee, and they meet once a month. And typically it's about the third Tuesday of every month.
Great. Well, we'll hold off any other further questions for Tim. And then up next is Steve Webb.
I think, Michelle, you've got my video off. There it goes. Good morning, everyone. I'm Steve Webb. I'm Director of Financial Services for West Virginia Economic Development Authority. We are a government agency, state government agency. Been in existence for 60 years. We have an independent board that reviews all of our loan applications on a monthly basis. Just going to cover that question right off the top. And we primarily provide financing in the growth phase or the mature phase of a company's life. We provide financial assistance for fixed asset acquisition to manufacturing concerns, industrial process complexes, distribution centers, high technology industries and technology-based service companies, and then other business classifications targeted by the West Virginia Development Office, which is a separate agency. And that is some forms of tourism, but it has to be targeted by the West Virginia Development Office. Our funding is largely, it's all loans. We have no grant funding. And one of the key components to access our funding is either the creation of new jobs or retention of existing jobs in the state of West Virginia. The business has to be housed in the state. We look at doing up to 45% of financing for fixed asset acquisition. That can include either a fixed equipment or, well, a fixed or fixed equipment, but it has to be of a non-rolling stock nature. So it cannot have tires, wheels, treads, wings, rotors, or any other method of transportation off the job site. It can be as small as a hammer or screwdriver, or as large as huge pieces of manufacturing equipment. Our loan policy incorporates loans as small as $50,000, which is 45% of about $210,000, $212,000 project, up to $10 million, which again would take maximum project size up to about $22 million. Although we do get involved in several projects that extend into the hundreds of millions of dollars. We do that on up to a 45% basis. We do have a minimum equity injection on any project. So if it's a land and building transaction, minimum 10% equity injection. For equipment, it's a minimum 20% equity injection. And for customizable equipment or something that's suited really only to the business it's borrowing, it could be resold on the market, then we can do that up to 35%. So when you hear what we can finance, we look for partner capitals in the capital stack. And equity of 10 to 30%, we'll do anywhere from 35 to 45%, and then bank or other source of funding can do the remaining piece. We are a permanent lender, permanent versus a construction phase or acquisition phase of an asset for the company. We only finance it after the land, building, or equipment is in place and in a revenue producing status. So it has to be on the site, has to be ready to work. And at that point in time, we can come in and buy down the project or construction phase financing and put that on a long-term fixed rate basis. It's generally tied to U.S. Treasury yields, depending on the amortization, up to 10 years for equipment or up to 15 for land and buildings. And I think the two most important things to remember is we are a loan fund, not a grant fund, and we do permanent financing, which is in the form of takeout financing of primary project lender. We work with a lot of folks that are on this panel today. Kevin O'Connor, who will speak in a minute, probably hates to see the phone ring with my phone number on it occasionally, but we will do some startup stuff. Kevin O'Connor and his organization partnered with us and another smaller lender in the state. Mid-Ohio Valley Regional Council often has loan funds, and we did a startup distillery, moonshine distillery. So we'll finance, it has to be a manufactured product. They make moonshine, so that qualifies. We've got, in addition to the $50,000 minimum to $10 million maximum, we also have a small pool of funding available for working capital to those target industries. Maximum amount of $500,000 of working capital, but it has to be a demonstrated need, and there are some funding restrictions. To say that means we don't have an unlimited pool of funds. So there could be a point in time where we no longer have working capital financing available if we get it all loaned out. And just because we'll do a $500,000 doesn't mean everybody gets a $500,000. You have to demonstrate that need either through your cash cycle for your product or something like that. We scrutinize those fairly closely, so that's subject to availability. We have some credit enhancement products, primarily loan insurance, where we will insure a bank's loan up to 80%. We have broadband loan insurance to ensure the expansion of broadband facilities in the state. We'll do leverage technology or high-tech insurance up to 90%. But we also are the tax-exempt bond conduit for the state. So we do tax-exempt industrial revenue bond financing. And we operate the state's foreign trade zones. I will stop there. If you ever have a question, please get in touch with me and I will get you either myself or a lender will be back in touch with you. And again, we meet monthly and our board makes the final decision. There is a formal application process. We underwrite much like commercial banks do. So if you've ever applied for a loan with a commercial bank, you'll be looking at a similar process with us. We've got a seasoned staff here and I think we work well and we're a little more flexible than traditional bank financing. I'll stop there, Michelle.
Steve, thank you very much. I did put a link to the West Virginia EDA into the chat. At this time, I don't have any questions, but we can hold off some of the ones that I have until the end. With that, Steve, thank you very much. We're now introducing Kevin O'Connor, and he will pick up the presentation.
Good morning, everybody. I'm Kevin O'Connor, Senior Vice President and West Virginia Market Manager for Partner Community Capital. And probably you may know us. We've been in, we're a nonprofit CDFI fund, and you probably know us by the name of Natural Capital Investment Fund. A few months ago, we changed our name to Partner Community Capital, and it's more of a branding. And it kind of shows more of our mission to be a partner, like with the lenders that are on the panel today. We partner, as mentioned, we do partner with them. And we're also looking at communities, what we can do. As a CDFI fund, you know, our mission is for economic development and really looking at communities that underserved, which means maybe there's not typically bank financing they may find in there. Maybe it's economic means. There's could be a lot of startups trying to redo their community. So what we look for is small businesses, nonprofits. There's a question, I think if Tim handled nonprofits, we can do nonprofit organizations. With that, we look at businesses that are using our natural resources responsibly. So that could be in the nature, we look at the timber industry, value added that, ecotourism areas, energy efficiency projects, we can do that. Farming and agriculture, value added, farm to table initiatives, we look at those type of projects. The ones we don't do are extraction, could be like in gas or coal mining development, those type of things. We're not involved in those type of industries. And again, our mission is helping small businesses. And again, it's like Tim mentioned, maybe a business can't find traditional financing and stand alone by itself with the requirements on the bank. So it could be needs of assistance for down payment assistance, collateral support. We come in, we can do, the bank requires 80% financing, the 20% gap. We can come in as a junior lender behind them and provide whatever the need may be, could be 20%. Also, we can look at, if we're looking at buildings, you may need improvement costs. So we can look at that as addition to purchase price plus improvements. We can help startups. That's an issue. We're not afraid of startups. We like startups. We look at based on a business plan and projections and how you are looking for, so we can use projected income. And it could be a business that we're seeing right now that's transitioned, maybe if it was involved in industry or they want to expand and your business isn't profitable enough for traditional financing or extra financing. Again, we can work with, look at projected income, and we do have technical assistance available that we can have you work with an accountant or to help to get your projections in order. Again, our bottom line, what we're looking at is job creation and what your business can do to create jobs and community benefit that you're providing your community. And it could be a restaurant, could be a coffee shop, could be a brewery. Breweries are becoming very destination for tourism into the state and the use of the natural resources. So if you want to put solar up, upgrades, energy efficiency upgrades, lighting, heating systems, we like those type of projects too. We are a loan program. We provide financing. We like to do equipment financing, real estate financing, and working capital. We can look at that and kind of bundle it together. Like Steve said, I worked with West Virginia EDA on his project. Sometime we can look at doing the bridge loan, getting the construction underway, and then until it's project and permanent financing is needed, and then Steve can come in on that portion. So I've teamed up with Steve on those instances. And again, we look at collateral. Our financing terms, I can do a loan from anywhere from $5,000 all the way up to 1 million. And our loan terms are going to go from 3 years to 20 years based on, the collateral that we're working with. My interest rates are going to be a little bit, we're a nonprofit, we're private nonprofit based on our funding and our risk. Typically we go up to, it's a little bit higher, 1 or 2% above what you'll see at your bank financing that we have. Our underwriting is pretty flexible. We look at it and we look at projects and businesses as, does it make sense? And our committees meet, if it's under 200,000, we meet weekly. And if it's above that, we meet twice a month on our loan committees. And just to give you an example of some of the businesses that I've done here over the past year, I had a startup handyman business. He needed a gutter installation equipment. We helped him on that. Daycares helped with that. Ecotourism, we're heavily involved in the Hatfield-McCoy trail system, building on cabin projects. For that, manufacturing, worked the past year with a brewery, distillery, a coffee roaster, meat processing plant, helped with that. Another startup was vacation van rentals. Again, that's helping with tourism, ecotourism in the state. So that kind of gives you some examples of what we do. We're here to help you. Again, we're looking for businesses that need help, and again, looking to help create jobs or even sustain jobs for businesses. So that gives you kind of an overview of what I have.
Great, thank you, Kevin. I don't see any open questions right now, but if you have any, remember to put those into the chat or the Q&A. Up next, we have Brad with the West Virginia Jobs Investment Trust.
Okay, I think we're waiting on my video to pop up here. Okay, there we are. Thank you, Michelle, and good morning, everyone. As Michelle said, I'm Brad Sargent, and I'm an investment manager at the West Virginia Jobs Investment Trust. Me and Michelle represent half the staff at the West Virginia Jobs Investment Trust, and we are the state's venture capital fund. We were created in '92 by the West Virginia legislature as a public venture capital fund with a mission to develop, promote, and expand West Virginia's economy by making investment funds available to stimulate economic growth and to create and retain jobs in West Virginia. What that means is we were designed to invest in companies, and unlike a lot of VC funds, we have an economic mission or component to our mission, and allows us to consider be a little bit more flexible and consider job creation and other economic benefits into our ultimate investment decisions. We invest in seed and other early stage companies that are looking to expand their overall business operations in West Virginia. We are limited to operations of businesses in West Virginia and West Virginia based businesses. As I think Tim and Kevin and some others said earlier in the presentation, we focus on non-bankable companies, and our goal is to move those companies on and get them to where they are bank qualified. We're industry agnostic. That means we don't focus on any specific industry. With that said, we prefer companies that are tech-based, meaning they are supported by either intellectual property developed or licensed to the company, or they are a tech transfer project from a university or an incubator from around West Virginia. We have current investments that range from a trout farm to fintech to medical technology companies. So you can see we cover a large array of business types. We prefer to be a minority investor and usually not interested in taking over a day-to-day operations of our portfolio companies. With that said, we can engage and come on a board of directors and serve as advisors when the situation arises. What we don't do equipment or real estate financing. I think we heard some earlier presentations that said that they fit in that portion of the capital continuum or the capital stack. We do not. We do not do Main Street businesses, so retail shops, restaurants, and things like that. I think that we heard some options earlier in the call on those as well. We do not do grants or low-cost loans. So where do we fit? Like I said earlier, we invest in seed and other early stage companies that are looking to expand their overall business. And we prefer, like I said, the companies that are tech-based. What our deals typically look like. Our deals range normally from $250,000 to $500,000 on the initial investment. With that, we typically know that businesses are going to need investment, additional capital. So we reserve some funds that we could come in and provide that if need be. We prefer to have a match or other investors coming into the round with us. We prefer not to lead, but when the situation arises that we can lead the investment round if needed. We do equity, debt, and hybrid financing. And I thought I could walk through a couple different high-level examples of those. The first and our most common structure is we do a convertible debenture, which is a loan that at a later date will convert to equity. So you say, what kind of company would need that? Why would a company do that? And we would do this for an early stage company that would prefer to do an equity deal later on that would allow the business to get the capital needed based on the future success of the company. The benefit for the business owner is that deferring the value of the business may enable founders to increase the valuation beyond the amount of the debenture financing. And this can reduce the dilution of the ownership down the road. We can do straight equity deals. That's for companies can raise money and the company growth is not saddled by being committed to paying a monthly, quarterly, or annual debt payment. It does dilute ownerships of the company, and companies that are asset light would focus on these types of deals. So typically a company that has little collateral to offer for either a traditional loan or any of the other lending programs would be normally the focus of that or the straight equity deal. We have, and it's fairly new to West Virginia JIT, we do have done revenue share agreements. We would do this for a company that is generating revenue, but also doesn't want to be saddled by the fixed debt repayment schedules. Also, it would be for a company that is not necessarily interested in giving up equity in the company. There could be multiple reasons for that. And that works by the investors are repaid incrementally as the company generates sales. You'd take top line sales, you would take a multiple, usually you're talking 1.5 to 2.5, and that multiple would come off total sales and be used to repay the revenue share agreement. With that, the company's revenue grow. With that, the company can scale revenue and the payments based on the revenue, so that could be paid over a shorter time. If growth occurs more slowly, investors will receive their return on investment over a longer time frame. So it doesn't lock the investor or the business owners into a specific debt repayment, and it doesn't give out equity, and it's just another option that we do have. I think that's all I have. I can answer any questions anybody has on that, or Michelle, if you have anything to add.
Brad, there is a question out there. Would a telecommunication installation company fit our portfolio?
That's a good question. I think we're open to looking at a lot of things. What's your opinion on that, Michelle? We would have to talk more about what the money was going to be used for, the company structure, and other things like that. I didn't mention that we do have an extensive underwriting and due diligence process that we go through, and then it is all our investments or recommendations are either approved by the board or turned down by the board.
Correct. And I think that's a good way to show that, we'll look at anything. It's always worth a conversation.
Yep. Yeah, and just to
One
piggyback-
question that we're going to circle back with that's been asked, but I think it's going to be best answered or asked whenever we get into the Q&A is, could any of the organizations work with first timers, and what is needed before starting a conversation with any of the organizations? So I'll have Brad, you start thinking about that while Mike tees up to do his presentation, and then we'll come back to answer some of those in the Q&A. Mike?
All right, thank you, Michelle. Good morning, everybody. Let me just say that I'm really delighted to be able to share this online stage with my esteemed colleagues. I think it should be also said that navigating the waters here in terms of getting investment dollars within West Virginia, I think we would all agree is pretty difficult. But the good news is that since we are a small state and all of us work together on a regular basis, if you throw a dart at any of us here, more than likely, you're going to find somebody who can either solve your problem or at the very least, point you in the direction of somebody who can. And that's the major advantage I think that we have here in West Virginia. So to those of you listening and watching on this webinar, don't get frustrated, find one of us and we'll point you in the right direction. Okay. Once again, my name is Mike Green. I currently chair the West Virginia Growth Investment Fund, which was an angel fund we started way back in 2013. And I'm currently the managing director of Mountain State Capital, which is a venture capital fund here in West Virginia and actually throughout the Appalachian region. If you look at funding in general, there are two parts to that, of course. There's the inbound funding, and that means that venture capital funds like us and others, the first thing we have to do is raise money from the private sources. So we are the ones who provide private capital to those companies that are in need of capital. And to do that, we, of course, raise money from individuals and in some cases from banks and institutions. And then on the outbound side, most of the investments that we make as venture capitalists are going to what we do call seed and early stage, sometimes dabbling in what's called Series A investments into companies. But we traditionally like to start with companies that are very, very small. Our focus as venture capitalists here in our community has primarily been over the last several years in software and information technology, IT, life sciences. We have some investments in semiconductors, a couple in consumer products, and more recently in ag tech, which is a growing area, and also fintech. So we look for companies that have already been established. And as Brad mentioned a few minutes ago, we will invest in two kinds of ways, one through debt and one through equity. You've all heard the term convertible notes. Sometimes people use a vehicle called a safe note. This is primarily a debt instrument. And the reason that is used by a lot of companies is because it's oftentimes very difficult to determine what the valuation of a company is when it just starts. So what I'm saying in plain English is a lot of times it's really an art to determine what the value of a company is. So by kicking the can down the road and doing a note or a debt instrument, we wait for a later event for somebody to come in and put a value on the company that note will convert into equity. But there are often times where it is pretty clear what an equity investment would be in a company. We know what the value is. We make an educated guess as to what that value is, and then we take an equity position. And it should be clear that as venture capitalists or as angel investors, we usually take, on the equity side, a piece of the company, but that's in exchange for our ability to help the company grow, to provide coaching, to provide mentorship, to provide legal and financial guidance, and make sure that best practices are always done by the company as they grow. So those are the main differences between some of the investment vehicles that are available to our constituents here in West Virginia that you heard from the earlier presenters. What we usually do when we look at this continuum that Michelle put up earlier in terms of the business stages and the funding stages is, let me just say, there's a risk reward type of element to it. And it should be very clear that the risk on the venture side is high on both sides. Oftentimes people think, well, it's a risky asset class for the investors for sure. It's also a risky asset class for the entrepreneurs who are literally counting on their partners who are providing the money to keep the company going or growing or at least starting to provide them the appropriate leadership that they need. But it's equally risky on the venture capitalist side, which is, sometimes people refer to venture capitalists as vulture capitalists. And there's some element of truth in that, but the reality of it is there's a bell curve associated with investing in this asset class. And generally looks like a third of the companies we invest in will fail. A third will perhaps be home runs. And the ones in the middle may produce a ground rule double or two, and we would get our money back that way. But it's an important asset class for our community. Frankly, there's not enough venture capital in West Virginia right now, which is why we are starting to continually to syndicate the availability of funds throughout the greater Appalachian area as part of an alliance that we've created and I serve on the board on, called the Appalachian Investors Alliance. And that'll be growing even more, where people and investors from outside of West Virginia are excited by some of the opportunities that exist here and are providing additional private capital into some of our companies. So as time goes on, you're going to see more venture capital, I hope, coming into West Virginia. And as Brad and Michelle know very well, there's a lot of federal and state money becoming available to us. But some of that funding, in fact, a vast majority of it does require private funding matching. And we hope in the future to be able to provide that funding because clearly we would like to take advantage of the amount of money coming our way from either Washington or Charleston. So I'll pause there, and if there's Q&A time a little bit later, I'll be happy to answer any other questions. Michelle, turn it back to you.
Mike, thank you very much. I'm going to go ahead and start the Q&A here, but Mike, since you are already teed up, and if everybody else, all the other presenters will go ahead and turn on their cameras. But here's the question, and Mike, you did discuss a little bit of it, but I want to circle back. Do any of our organizations work with first timers, and what do they need to start that conversation with any of our organizations? Mike, I'll start with you.
Well, from a venture capital, or let's back up and say we also have what are called angel funds, and there is a nice angel fund based out of Beckley called Country Roads Angel Network, and they historically will invest perhaps at the very early stage and provide some funding to, I would say, real startups that have never, done a business before. That's not the usual case for venture capitalists. We usually look for experience, but it is done. I mean, let's just be real honest about it. We who provide funding are opportunistic people. If we see something that's very, very interesting and has a good future, then yes, there are opportunities where we will invest in something that's very early stage and brand new and a real startup.
Great. Brad, what about JIT?
Yeah, yes, we'll talk to first timers, and we're more than willing to work with them. I think normally how we started is, we said we want them to send us either an executive summary, business plan, so that we can wrap our heads around what their idea or what their company is, and then we'll go over that and set up a call to go over it. And then during that process, we can generally, as we get to know the opportunity better, then we can let them know that if it's yes, something that we can work with, or no, it's not, and we can pivot and go towards our due diligence and underwriting process.
Steve, what about the EDA?
We will do startups and new technology from time to time. But I think one of the important aspects to remember about that segment of the economy is if you have a new product or new technology, there will be requirements of a market study, proof of concept, independent testing, and things to determine that just because it's a good idea, you can make one, is there a market for it before we can actually take that risk? So whether that's a new piece of equipment that's never been invented before, or you've got some kind of new technological process to make a better mousetrap, just keep in mind that there will have to be some underwriting of that process. We won't just take your word for it.
Tim, what about First Microloan?
We predominantly do startups. That's the one major focus with the microloan program is a startup aspect. We are just like, we are debt financing. So we don't have a lot of the angel requirements and so forth as Mike and Brad was talking about, but we do have it's a traditional debt piece. We will look at the business plan, the strength of it. We're character-based lenders. So probably I would say maybe 70% of our portfolio is actually startup business. So we will deal with a lot of startups. They're harder. They are. There's no denying that. It's where the business plan and financials come into big effect here. And we partner with multiple agencies across the board. And, throughout the United States, you have the Small Business Development Center network, and West Virginia has a very good SBDC system. That's my inglorious plug there. Sorry, but there's also other agencies throughout the state. Kevin knows as well. We work with everybody. We have our own TA aspect that we work with, technical assistance wise, working with folks. So there's a lot of stuff from the startup end that we are able to do that a lot of the other banks and other agencies can't touch. I mentioned restaurants earlier, so that's usually a big one that we deal with on the startup end.
Great. Kevin, what about Partner Community Capital?
Yeah. So we do look at startup businesses. We do quite a few. Actually, I've done like 3 in the last month here. And what you need to do, and one thing I'll mention is Partner Community Capital. We sponsor the West Virginia Women's Business Center, and that's now active. And they have business coaches available. And that's an option for you to get started, is to get with a business coach and to create a business plan. We like to see that, and put your thoughts on paper. And like Brad was saying too, an executive summary, what's your marketing, what's your product, who's your customers, what's your competition. And again, it's a business plan, and it kind of helps you. My position on these is it helps you as a business person. It's like a budget. What am I looking at? What's my operating costs going to be? Where do I think my business sales are going to be? And again, it doesn't have to be a novel. Don't create a 40-page business plan to look impressive. It's just enough information for us to wrap our heads around it. And does it make sense? And that's kind of our theory on that is. And when to get involved, feel free to call anytime. I'm open for discussion. I can look at business plans, give some guidance to it, and kind of like Mike was talking about. And we know everybody. I can send you talk to another lenders as well too, and just to develop the network that we have here in the state of West Virginia is pretty outstanding.
Great. There's a couple questions. I'm gonna just throw it out to whoever wants to answer these. Larry and Angela kind of have a similar question. First off, it doesn't sound like there's a specific format for a startup on their business plan, but in essence, we need to have a business plan that addresses certain things. So if anybody wants to address that question, the follow-up to that is we've seen some great entrepreneurs come in with ideas, but maybe they don't have the management team wrapped around the business side. How important is it to any of you that the idea needs to have the business side handled through management and a team, and the format of the business plan?
I can start that discussion off if it's okay, Michelle.
Go ahead, Brad.
And that's one of the things with, I mentioned that we have an extensive underwriting process. I didn't include anything that we were looking at, but this question, or that we look at, but these 2 questions feed into that. Normally, from our perspective at JIT, we're looking and we want to see in your business plan and management and a discussion about that management as we're going to evaluate what we think of that management. Also, corporate structure and governance, capital structure and needs. We're going to expect a market opportunity analysis there, as I think some others mentioned earlier. We want you to touch on the competitive landscape, any barriers to entry any competitors would have or that the business faces. If there's any kind of numbers or any work that's been done towards valuation. And for us, we're looking at what's the exit strategy. We're not a long-term investor. We want to know how we can help you get to that bankable and what our exit is as well. So that's some of the information or a lot of the information we would want to see on the business plan. And on the second question, the management evaluation is part of our process.
I'll add on to that if I can, Michelle. So we rarely, no, we never see a early stage startup company that has all the answers. What we hope to find is somebody who has at least all the questions that they know that these are the things they're going to need either really soon or in the future. What we look for, frankly, is people who are honest and straightforward, know what they know what they don't know, and come with a rational plan in plain English, like Kevin said. Don't have to write us a novel. We don't want to read. We're too lazy to do that in the first place. But tell us your story in as simple terms as you possibly can. And if there's something there, then we'll either tell you that we can fund it, or we'll tell you to do something else. I usually say it in a much more negative way, but if your idea is bad, at least at our stage in venture capital, we will tell you that's a terrible idea. Or did you realize that there are at least 20 entrepreneurs in Silicon Valley and 10 in Boston and 8 in New York who have already done this? So obviously you haven't done your homework, but come to us with a rational plan. And I think for all of us here, speaking for all of us, if it's rational, logical, and deserves funding, almost all the time, we will find a way to provide that kind of funding. But do your homework. That's the key word to the entrepreneur. Do not come in and wing it. And we have too many that come in and say, I got this crazy idea, whether it's a bar, a restaurant, or somebody with a great new technology that's going to solve the world's problem in artificial intelligence. Sometimes they come in, they just wing it. That doesn't work. Come in prepared.
Yeah, Michelle, just got a couple of comments on what both Brad and Mike mentioned. Brad mentioned taking a look at barriers to entry, and that's barriers to entry for the applicant company, but also what is the protection to barriers to entry on someone else that brings a new process or new product. Have you looked at the patentability of your new process or new product before you start to invest tens or hundreds of thousands of dollars to bring that thing to market? Don't build something that somebody's 3 steps ahead of you on the patent process. By the time you get it built and you borrow all the money, your market's gone. So you've got to take a look at that. And as Mike alluded to, do your homework. Make sure you're not inventing the mousetrap that somebody on the other coast has already invented. So just take a look. Make sure you just pay attention.
Right. Well, as we start to wrap this up, I hope we've been able to provide a great overview of the capital stack and where, if you've been to a traditional bank for a business loan or are contemplating starting a business, that, there are alternative options out there outside of a traditional bank, credit cards, which we've seen a lot of, and other online business lenders. So there's resources within the state of West Virginia that are here to help answer your questions, guide you. 3-Step Startup definitely is a portal that if you wanted to talk to anybody about that and be able to provide some feedback on best places to find the resources that you need to launch your business or connect you with a business coach. We talked about the West Virginia's SBDC. We also talked about the Women's Business Center, and there's other resources out there as well. So we thank you very much for your time attending